You're looking at your financial aid package, and you see the federal loan offer, but you know there's still a gap to cover. Your first instinct might be to go to your bank or an online lender for a private student loan. Stop right there. Choosing between federal and private student loans isn't just a minor financial decision. It is a choice that will define your financial flexibility and stress level for the next 10 to 25 years of your life. These are not the same product with different names, they are fundamentally different financial instruments. With federal loans acting more like a social safety net and private loans acting like a traditional, rigid debt, I've seen too many borrowers crippled by private loan debt because they didn't understand the monumental differences in borrower protections before they signed on the dotted line. This video is your definitive guide. We're going to do a head-to-head comparison on every critical factor, from who lends the money and the application process, to interest rates, repayment plans, and what happens when life goes wrong. By the end, you will have a crystal clear understanding of why the advice to max out federal loans first isn't just a suggestion, it is a rule for financial self-preservation. Let's start at the very beginning, the lender and the application process. This is your first major clue about how each system operates. Federal student loans come from one source, the U.S. Department of Education. They are part of a public program designed to promote access to education. To apply, you fill out one form, the FAFSA, the Free Application for Federal Student Aid. This form looks at your family's financial situation to determine your need. There is no credit check for most federal loans. Your eligibility is based on the information you provide on the FAFSA. The only exception is for Parent Plus and Grad Plus loans, which do have a credit check, but it's primarily for an adverse credit history, not for a high credit score. Now, contrast this with private student loans. Private loans come from private entities, banks, credit unions, and online lending companies. Their goal is to make a profit. The application is a standard credit application. They will run a hard credit check and require a good to excellent credit history to get the best rates. For most undergraduate students with little or no credit, this means you will almost certainly need a cosigner, a parent, relative, or friend with strong credit who agrees to be legally responsible for the loan if you can't pay. This immediately places a massive burden on someone else and intertwines your financial life with theirs. The application process itself tells you everything. Federal loans are about access, while private loans are about creditworthiness. Now, let's talk about the terms of the loan itself, starting with interest rates. This is where many people get tricked. Federal student loans have fixed interest rates. This means the rate is set by Congress for that academic year and it will never change for the life of the loan. You have complete certainty. The rate is the same for every borrower who gets that type of loan that year, regardless of their credit. Private student loans, on the other hand, can have either fixed or variable rates. Variable rates often start lower than federal fixed rates, which makes them look attractive. But a variable rate can and will increase over time, sometimes dramatically, as market interest rates rise. That low introductory rate could balloon in a few years, making your monthly payment unaffordable. Furthermore, with private loans, your interest rate is based entirely on your and your co-signer's credit. The worse your credit, the higher your rate. So while federal loans offer predictability and equality, private loans introduce risk and inequality based on your financial background. This is all important, but the single most significant difference, the one that can be a literal lifesaver, lies in repayment options and borrower protections. Federal loans are built with the understanding that life is unpredictable. They come with a suite of safety nets that are mandated by law. First, you have a variety of repayment plans. You have the standard 10-year plan, but you also have access to income-driven repayment plans. These plans cap your monthly payment at a percentage of your discretionary income, usually 10%. If you lose your job or have a low income, your payment can be as low as $0, and that $0 payment still counts toward forgiveness. After 20 or 25 years on these plans, any remaining balance is forgiven. There is also public service loan forgiveness, which forgives your remaining balance after just 10 years of payments if you work for a government or nonprofit employer. Furthermore, if you run into trouble, you can request deferment or forbearance to temporarily pause your payments, often with the government continuing to pay the interest on your subsidized loans during a deferment. Now, let's look at private loans. Their repayment plans are typically much less flexible. You might have a choice between a 5, 10, or 15-year term, but that's it. There are no income-driven repayment plans. If you lose your job, your payment is still due in full. They may offer forbearance, but it's often shorter, harder to qualify for, and interest continues to pile up, capitalizing at the end of the period. And most importantly, there is no loan forgiveness. You are on the hook for every single penny you borrowed, plus all the interest, no matter what happens in your life. This is not an exaggeration. This is the core risk of private student debt. Finally, let's talk about what happens in the worst-case scenarios. With federal student loans, if you become totally and permanently disabled, your loans may be discharged and forgiven. If you die, your federal student loans are discharged, and your family isn't responsible for the debt. With private student loans, this is not always the case. The discharge due to disability is not guaranteed and is up to the individual lender's policy. And if you die, your cosigner could still be held fully responsible for the remaining balance, which is a devastating financial and emotional burden to leave behind. The difference in safety nets is staggering. Federal loans are designed to be manageable throughout the ups and downs of your career. Private loans are a rigid, legal contract with little room for error or misfortune. The choice is clear. Always exhaust every dollar of federal student loans you are offered before you even consider a private loan. Use private loans only as an absolute last resort to cover a small, final gap after you've used federal loans, scholarships, grants, and personal savings. Your future financial flexibility depends on this decision. Choose the loan that gives you options, not the one that boxes you in. Before we finish, a critical disclaimer: I am not a licensed financial advisor or a student loan counselor. The information in this video is for educational purposes only. Loan terms, interest rates, and forgiveness programs can change based on federal legislation and lender policies. You must always consult the official government student aid website at studentaid.gov and your loan servicer for the most current information and for advice tailored to your specific financial situation. Borrowing for education is a major decision with long-term consequences, so please do your own thorough research.